Welcome to the Deep Dive, your shortcut to the critical knowledge nuggets buried in earnings calls. Today, we're diving into the fourth quarter and full year 2025 results for Citi, which dropped on January 14th.
And this was definitely a complex one.
Absolutely. Our mission here is to unpack this quarter because, well, it was a mixed bag, to say the least. You had this messy surface-level report, a really swift and skeptical market reaction.
Right.
But then you have management telling a very different, very optimistic underlying story. So we need to figure out if investors are missing the big picture or if that skepticism is, completely justified.
Let's start with those headline numbers, because that's really what drove the initial confusion.
Yeah.
The reported GAAP numbers, they just looked weak. We saw reported earnings per share of $1.19.
Which is down quite a bit from last year.
Exactly, down from $1.34 a year ago.
Yeah.
And then revenue came in at $19.9 billion, which missed the street consensus by a pretty noticeable margin.
Yeah.
So that's the weak picture.
Okay, so that sounds like a clear miss. But with these big banks, especially one going through a huge transformation, you always have to look past the surface, right? What was the clean story management was pushing?
Precisely. Management's focus was entirely on the adjusted results. They were arguing that the underlying businesses showed really solid momentum. If you exclude one specific massive notable item, their adjusted EPS was actually $1.81.
Which beat expectations.
It did. It beat the consensus of $1.67. And their adjusted revenue was $21 billion, which is up 8% year over year. So the entire quarter really hinges on whether you buy that adjustment.
So let's talk about that adjustment. What was the elephant in the room that buried that adjusted beat?
It was a $1.2 billion loss on sale. And this was tied to the held-for-sale accounting for their planned exit of AO Citibank in Russia.
So it's a strategic cleanup, not an operational miss.
That's management's argument, yeah, that this is a one-time thing tied to simplifying the bank. It's not a failure of the core franchise.
Okay, that makes sense. But the market didn't fully buy the X notable progress narrative, did it? The stock closed down over 3%. If they beat on the clean number, why the sharp drop?
I think investors sort of accepted the Russia loss as non-recurring. But that stock decline, it signals two deeper worries. First, the reported revenue miss was still there. And second, and this is much more critical, the market is intensely focused on the expense base.
The cost of the transformation.
Exactly. The pace of the firm's multi-year transformation. This is where the story shifts from Russia to, really, efficiency.
That's the real heart of it, isn't it? Let's dig into that operational leverage and efficiency question, because that seems to be the main friction point. What did the expense numbers actually look like?
Well, they came in hot, $13.8 billion, which is up 6% year over year.
Wow.
Yeah, and when you run the calculation, that drove the reported efficiency ratio, which tells you how much it costs to make a dollar of revenue, to a high 69.6% for the quarter.
And their long-term goal is what, 60%?
Around 60%.
Yeah.
So they're still very, very far from that target, and I think investors are just getting impatient.
But management did say they achieved positive operating leverage firm-wide for the full year on that adjusted basis. So how do you square that with expenses growing so fast? Are they just, masking the real spending problem?
Well, this is the critical trade-off they're making. Management addressed this head-on. They acknowledged that $13.8 billion is high, but they argued it's necessary spending. It's driven by compensation, massive tech investment, and all that transformation work the regulators are requiring.
It sounds a bit like a massive, drawn-out home renovation.
That's a great analogy, actually.
The long-term value will be there, but right now the scaffolding and the dust, the high expenses are just dominating the view.
That's it, exactly. Management is asking for patience. They're saying this spending creates capacity for future durable growth. They're investing to, earn the right to be a world-class competitor again.
So, given that narrative, we saw a small but I think very significant shift in their 2026 efficiency guidance on the call.
We did. It was a major point of questioning. While their long-term goal for ROTCE, their key profitability metric, that stays at 10 to 11%. They softened the near-term language.
Right. They used to say below 60% for 2026.
And now they're targeting around 60% for 2026.
That little change from below to around, in the world of guidance, that's huge. What's the real implication there?
Flexibility. I mean, that's the bottom line. They explained it gives them the wiggle room to keep investing heavily in the franchise, in tech, in talent to drive returns not just next year, but into 2027 and beyond.
So they're choosing to sacrifice a bit of near-term credibility on efficiency to make sure the franchise is funded for the long haul.
Absolutely. And investors are scrutinizing that hard. But if the short-term cost is the headache, where does management show us the cure? And that brings us to the strength of the core businesses, which are frankly, performing very well.
Okay, let's talk about those growth pillars. When you look under all the transformation costs, what actually stood out from the business units?
The most important number this quarter, and it often gets lost in the expense debate, is the services division.
The powerhouse.
An absolute powerhouse. Services, so that's Treasury and Trade Solutions and Security Services, it delivered an incredible return on tangible common equity of over 28% for the full year.
28%? I mean, that's just incredible for a global banking operation. Why is that division so powerful for them?
It's a low capital intensity and it's highly stable fee income. I mean, this is the engine room of global finance. They saw 14% growth in cross-border transaction value and a massive 24% increase in assets under custody. That business just provides this steady earnings power.
Okay, so services the rock. What about the other core segments?
Markets also had a stellar year. Record full-year revenues and a ROTCE of 11.6%. A lot of that came from a 50+% increase in prime balances, so they're gaining share there.
And
Wealth also showed really strong momentum. ROCE over 12%, and crucially, 8% organic net new investment asset growth. That shows they're bringing in new money, not just riding the markets.
And finally, banking, which, I mean, it was a tough environment for M&A everywhere.
It was, but they still managed an 11.3% ROCE, helped by record M&A revenues. So the story they're selling is, pretty compelling. 4 core businesses all delivering double-digit returns.
And that underlying growth feeds right into the net interest income outlook, which is a huge driver for bank stocks. Did they update their NII guidance?
They did, and this was a key win for the bulls on the call. Management now expects NII, excluding markets, to be up 5 to 6% year over year in 2026.
And that's driven by what? Card growth.
Exactly. Expected volume growth in cards and wealth, plus the investment portfolio rolling into higher yielding instruments. Helps counteract some of that expense anxiety.
Okay, let's switch gears to risk. What about credit? Are we seeing any significant stress building up?
Not according to the call, no. The total provision for credit was $2.2 billion, mainly from net credit losses in their U.S. cards portfolio. But they were quick to point out their portfolio is still high quality.
What does that mean in practice?
It means roughly 85% of their consumers have FICO scores of 660 or higher. And importantly, card net credit losses are expected to stay within the guided ranges, so no big surprises there.
Let's pivot back to strategy. The transformation has been the mantra for years now. Did management provide any tangible proof that this whole costly project is actually paying off?
They did. The key evidence was a specific regulatory milestone. They announced that over 80% of their internal transformation programs are at or near their target state. And more crucially, the OCC, the regulator, removed Article 17 of the consent order in December.
And what does removing Article 17 actually signify?
Management sees it as public, demonstrable proof of improvement in the firm's safety and soundness. It's a formal nod from the regulator that they've fixed a critical area.
But the CEO was pretty careful to manage expectations on that, wasn't he?
Very careful. He cautioned that, full regulatory closure is a long, drawn-out process. The timing is up to the regulators, not the bank. They still have a lot of critical data work to finish.
That ongoing regulatory focus brings up an external headwind. This push for a 10% rate cap on credit cards in the U.S., that would be, catastrophic.
Yeah.
How did the CEO respond to that?
The response was unequivocal, firm. He said they absolutely cannot support a rate cap, citing the catastrophic impact it would have on access to credit for most U.S. consumers and businesses. He even referenced historical precedents where similar controls had to be rescinded almost immediately.
Right. Before we move on, we have to acknowledge the big leadership change. Mark Mason, the long-serving CFO, is stepping down.
Yes, after 7 years. And in banking, during a transformation like this, that is a very long time. It's a significant break in institutional knowledge.
The CEO seemed very appreciative of his work.
He was effusive. He highlighted Mason's work guiding the bank through the pandemic and, critically, driving all that remediation work. It definitely adds a layer of transition risk to the whole story.
So what does this all mean for the investor? The market being down over 3% tells us they're just not giving full credit for that adjusted beat. They want proof of operating leverage. That 10 to 11% ROTCE target feels, pretty distant.
That's spot on. The stock is trading on the path to that target, not the current run rate, which means the single most important lever the bank has to support the stock is capital return.
And they are being very aggressive on that front.
They are. They repurchased over $13 billion in common shares in the 2025, with $4.5 billion just in Q4. That's a huge part of their $20 billion buyback program.
And they have the capital to keep going.
Absolutely. Their CET1 ratio is 13.2%, which is way above the regulatory minimum. It signals continued aggressive buybacks in 2026.
Okay, time for the outrageous but plausible trade idea we heard pitched this morning. And a reminder, this is for entertainment and intellectual curiosity only. Definitely not financial advice.
Right. So given this split in the market, punishing the stock for expenses, despite strong fundamentals, we're pitching a transformation credibility hedge.
Okay, I'm listening.
The trade is this. You short the common stock, but only if the reported efficiency ratio stays stubbornly above 68% in the next quarter.
So you're betting on investor fatigue.
You're betting on fatigue, exactly, that the high expense base will drag the stock further below book value because it puts that around 60% target and the whole long-term ROTCE goal into question.
But that's risky with such a massive buyback program. What's the plausible twist that hedges that?
The plausible twist is you simultaneously go long a basket of the bank's best segments via proxy. So you could look at, say, services or TTS peers, or maybe specialized wealth management peers.
So you're betting on the value of the core franchises.
Exactly. You're betting that the internal value of that spectacular 28+% services business will outperform the valuation drag caused by the slow, painful cleanup. The thesis is the core is strong, but the operating expense cleanup is the systemic risk to the stock price.
That was a deep dive into the Citi 4Q25 results. If we zoom out, the central takeaway for investors is pretty clear. You have impressive underlying performance and strong capital return, but it's all masked by that Russia exit loss and, more importantly, this lingering skepticism about expense discipline.
The path to that 10 to 11% ROTCE is mapped out, but the execution risk is everything right now. And that decision to revise the 2026 efficiency target to around 60%, well, it buys them flexibility, but it costs them some near-term credibility with investors.
So we'll leave you with this provocative thought. With over $13 billion returned to shareholders in 2025 and an aggressive plan ahead, are you willing to look past the current expense base and trust the path to that 10 to 11% target? Or does the ongoing complexity and cost of this transformation make it purely a capital return story first and a growth story a distant second? Thank you for joining us for this deep dive. We hope you feel well-informed and ready to tackle the market.